Portfolio rebalancing is a crucial tool for investors to manage their investments actively. It helps to maintain desired asset allocations, reducing unintended risk in the portfolio. This strategy is particularly important for mutual fund investors as market movements can affect asset allocations. By rebalancing regularly, investors can align their investments with their financial goals and achieve consistent returns over the long term. In this video, we will unravel the mysteries behind mutual fund portfolio rebalancing, answering burning questions and shedding light on some of the best practices. Welcome to holisticinvestment.in. Why is rebalancing required? Portfolio rebalancing is necessary because your investment mix can deviate from your target allocation over time, similar to a recipe's ingredients changing in proportion. It involves readjusting your portfolio to its original or desired asset allocation, ensuring the right balance of risk and return based on your investment strategy. For instance, if your initial plan was 70% stock and 30% bonds, but due to market fluctuations, stock now make up to 80% of your portfolio. Rebalancing involves selling some stocks and buying more bonds to maintain the 70-30 split. The primary purpose of rebalancing is risk management. It prevents one asset class from dominating your portfolio excessively, reducing the risk exposure beyond your comfort level and keeping your investment plan on track. Next, when you should rebalance. Determining the optimal timing for portfolio rebalancing is crucial for mutual fund investors. There are two main categories of triggers for rebalancing. First, individual outcomes, and the second is changing macroeconomic factors. First, individual outcomes. Financial milestones. Rebalancing is recommended as you approach financial goals to align your investment mix with your risk tolerance and objectives. For instance, transitioning from riskier to safer investments can help safeguard your wealth. Life events. Major life events like starting a new job or expanding your family may necessitate adjustments to your investment strategy to ensure it still reflects your financial aspirations. Change in risk appetite. Shifts in risk tolerance, whether increasing or decreasing, can prompt rebalancing actions such as adjusting exposure to equities for higher returns or shifting towards more conservative assets for capital preservation. Next, changing macroeconomic factors. Responding to the market corrections. Rebalancing enable reallocating funds based on sector or asset class performance, maintaining alignment with your risk tolerance and market conditions. Changing market valuations. Adjusting your portfolio based on market valuations, whether stocks are overvalued or undervalued, allows you to optimize your investment according to the market conditions. Understanding when to rebalance is vital, but it is equally important to consider how frequently to rebalance, which we will explore in the next section. In a recent research paper, the Vanguard team explored three common methods. When it comes to rebalancing portfolios, investor can consider these three common methods: calendar-based triggers, threshold-based triggers, or a combination of both. First, calendar-based trigger. This method involves choosing how often to adjust your portfolio based on a set schedule, like annually. While this reduces deviation from the target allocation, frequent adjustments can lead to higher cost, especially if additional funds aren't readily available. Tax implications, particularly regarding capital gains, also need consideration. Next, threshold-based trigger. This strategy triggers rebalancing when the portfolio deviates by a specific percentage from the target allocation, such as plus or minus 5%. Daily monitoring is required for this method, which may not be practical for many investors. Smaller threshold reduce tracking error but increase transaction costs. Next, combined calendar and threshold based rebalancing. This approach combines both methods, rebalancing the portfolio at set intervals based on the calendar while making adjustments if the deviation from the target allocation exceeds a specific percentage. Choosing the right method depends on individual preferences, monitoring capabilities, and balancing tracking errors with transaction cost. The chart here indicates that using a calendar-based approach with a 5% threshold gives an optimal and efficient strategy for portfolio rebalancing, taking into account transaction cost and tax considerations. One of the most debated questions in investment circles is whether portfolio rebalancing leads to improved returns. While there is no definite answer, let's explore this concept using the calendar and threshold triggers discussed earlier. Rebalance 1. Seizing opportunities during market volatility. Consider a scenario where your portfolio was initially set at 60:40 equity debt ratio in February 2020. Due to sharp market decline in March, your equity allocation dropped to around 45%. This significant deviation prompted a rebalance to restore the 60:40 split. By doing so, you took the advantage of market dip, buying equities at lower prices and actively managing risk, potentially enhancing investment outcomes. Rebalance 2. December 2022. Navigating the bull run peaks. In late 2022, during a bullish phase, your equity investments may have surged, leading to an imbalanced allocation, say 75:25 in favor of equities. Scheduled annual rebalancing triggered adjustments by selling equities and reallocating into more stable instruments like debt funds or bonds. For instance, using the Nifty 10-year benchmark GSEC index as a proxy for bonds, rebalancing in December 2022 resulted in a subsequent 10% increase in the GSEC index over the next year, surpassing the Nifty CAGR in the same period. This illustrates how rebalancing can help stay above average market returns. While these examples may not always repeat, the key takeaway is that rebalancing can potentially yield better outcomes than not rebalancing. To conclude, portfolio rebalancing is an essential and strategic tool for navigating the dynamic financial markets effectively. Whether capitalizing on market downturns or locking gains during bullish periods, rebalancing ensures that an investor's portfolio stay in line with their risk tolerance and financial objectives. These examples highlights the proactive nature of rebalancing, allowing investors to leverage market fluctuation for optimization. The key lesson emphasizes the importance of regular review, enabling adjustments to asset allocation and maintaining a resilient, well-diversified investment portfolio. As financial landscape continue to evolve, the judicious use of rebalancing remains critical for achieving consistent risk-adjusted returns over the long term. Happy investing. A detailed blog post on this topic is available in our website and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming Enlightening Investment Webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.